The silence before the storm. It's Sunday evening, January 18th, 2026, and I need to tell you something that most people won't realize until it's far too late. I'm a private commodities analyst. I've been tracking physical silver markets for 12 years now. And if you want to know who's actually behind this AI avatar, there's a channel intro on the homepage. But right now, we don't have time for backstories. Right now, while the world is watching football and scrolling through their phones, the global financial plumbing system for silver is hitting a literal brick wall. The mainstream financial media spent Friday afternoon talking about a Greenland real estate deal. They framed it as geopolitics. They called it diplomacy. They used words like negotiating tactic and trade leverage. The screen is showing you a narrative, not reality. This isn't about land. This isn't about Arctic minerals or strategic positioning or any of that surface-level analysis you're going to read in the Wall Street Journal tomorrow morning. This is about a physical liquidity trap that is about to strangle the London Bullion Market Association, and by extension, the entire global silver pricing mechanism. Here's what actually happened. On Friday night, the administration dropped what I'm calling the nuclear tariff bomb. 10% tariffs on imports from 8 European Union nations, plus the United Kingdom, effective February 1st. That's 14 days from now. And here's the part that should make your hair stand up. That list includes the UK, home of the LBMA, the single most important silver trading hub on planet Earth outside of New York. By the time the opening bell rings tomorrow night, when futures markets open, the economic pathway for silver to move across the Atlantic Ocean won't just be expensive. It will be economically impossible for the bullion banks to maintain their standard operating procedures. But that's not even the worst part. Let me be very clear about what I'm claiming here, because this is not speculative. This is math. Trump's 10% tariff, which escalates to 25% if no Greenland deal is reached by June 1st, has created what I'm calling a one-way valve in the global silver market. It has effectively trapped millions of ounces of physical silver within United States borders, leaving the London markets to starve on their existing inventory. And here's the stake. If the LBMA cannot borrow metal from the COMEX vaults in New York to cover their short positions, the global pricing mechanism breaks down completely. We're not talking about a price squeeze that takes silver from $90 to $110. We're talking about a fundamental fracture in how this metal is valued globally. We're looking at a scenario where physical silver could legitimately trade above $100 per ounce, not because of investment demand, but because of a structural impossibility in the supply chain. I'm going to walk you through 3 things in this video. First, I'm going to explain exactly how this geographic arbitrage trap works and why it matters more than any other factor in the silver market right now. Second, we're going to run the actual stress test math on what happens when that 10% becomes 25%. And third, I'm going to share my personal battle plan for the Monday Open and the next 14 days because I've been in this market long enough to know that when the music stops, you want to already be sitting down. Before we go any further, I need you to understand something. Gold is the money of kings. Central banks hold it. Governments hoard it. It's the anchor of the monetary system. But silver is the Achilles heel of the entire banking system. And that heel is about to get shot with an arrow. Let me give you the hard data. As of this afternoon, around 2:30 p.m. Eastern Standard Time, silver was trading at $89.94, down 1.62% from Friday's close. Gold was at $4,596.87, down 0.28%. Now, if you just looked at those numbers, you'd think the market was reacting rationally. Tariffs typically mean a stronger dollar, and precious metals usually dip on strong dollar news. The algorithm saw tariffs and executed their standard playbook. But here's what the paper market doesn't understand yet. The physical reality happening underneath those ticker symbols. While paper prices dipped slightly on Friday, the bid-ask spread started widening. Not dramatically, not in a way that would trigger CNBC alerts, but if you're watching the actual physical dealers, you saw it. The spread between what someone will pay for an ounce and what someone will sell for started stretching. And the Friday night surprise, the actual tariff announcement that happened after the LBMA had already closed for the weekend. London doesn't even know they're in a trap yet. Let me give you some context that makes this even more insane. In the first quarter of 2025, we watched dozens of millions of ounces of physical silver flee London vaults and land in New York. The bullion banks thought they were being smart. They were front-running the Section 232 review that everyone knew was coming. The Section 232 review is the mechanism the administration uses to determine if imports threaten national security. And silver as a strategic mineral used in everything from solar panels to missiles was obviously on that list. So the banks did what banks do. They moved their metal ahead of potential restrictions. They repositioned their physical inventory from the LBMA into COMEX warehouses, thinking they'd be safe from any supply chain disruptions. And now with one announcement, with one weekend tweet, the door has been locked from the outside. The metal is trapped in New York, and the banks just lost their ability to play whack-a-mole with physical shortages across the Atlantic. How a geographic arbitrage trap actually works. Let's slow down here. I'm going to teach you a concept that most retail investors have never heard of, but that institutional traders live and die by. It's called a geographic arbitrage trap. Here's the simple definition. This occurs when the cost to move an asset between two global exchanges becomes higher than the price difference between those exchanges. When that happens, the flow of supply completely paralyzes. Let me give you an analogy that makes this crystal clear. Imagine you have two wallets. Your left pocket, let's call it London, is completely empty, and you've got a bill due that you need to pay immediately. Your right pocket, New York, is stuffed full of $100 bills. Normally, you just move some cash from your right pocket to your left pocket and solve the problem. But here's the catch. Every single time you move a $100 bill from your right pocket to your left, the government intercepts it and takes $25 as a tax. You're technically rich in one pocket and functionally bankrupt in the other, and you can't fix the problem without losing 25% of your wealth in the process. That's a geographic arbitrage trap. Now let's apply this to silver markets today. The United Kingdom, specifically the LBMA, is critically short of physical silver. They've got obligations, they've got contracts, they've got delivery demands from funds and industrial users who need actual metal, not paper promises. Under normal circumstances, this wouldn't even be a problem. And when London gets short, they just arrange a shipment from New York. Metal moves across the Atlantic every single week. It's part of the global flow that keeps prices synchronized between exchanges. The mechanism works like this. If silver is trading at $90 in New York and $91 in London, arbitrage traders will buy in New York, ship it to London, sell for a $1 profit, and pocket the difference after shipping costs. That constant flow of metal from low price to high price zones is what keeps global markets balanced. But with a 10% tariff and eventually a 25% tariff, that metal can never economically return to the United States without the banks taking a massive loss. Think about what that means. If you're a bullion bank and you ship 1 million ounces from New York to London to cover a short position, you've just made that metal 25% more expensive to ever bring back. The result is that two separate prices for silver are about to emerge. I'm calling them the trapped US price and the starving London price. And when those two prices decouple, when the arbitrage mechanism breaks down completely, we're going to witness something that hasn't happened in modern precious metals markets. Let me walk you through the actual math because this is where theory becomes reality. Scenario A, the 10% friction. At $90 per ounce, a 10% tariff adds $9 to the cost of every single ounce imported into the United States. What does that mean practically? It means that if silver is trading at $90 in New York and $95 in London, it's still not profitable to ship metal from London to New York because you'd pay $9 in tariffs and lose $4 on the trade. This immediately creates a floor for US physical metal. Domestic silver cannot fall below the London price minus the tariff cost, or arbitrage would kick in and equalize things. But here's where it gets dangerous. Scenario B, the 25% nuclear option. If no Greenland deal is reached by June 1st, and I personally think the odds of a deal are lower than the media is suggesting, the cost to bring silver back into the United States jumps by $22.50 per ounce at current prices. Let me say that again, $22.50 per ounce. Now the LBMA is rumored to be critically short. I don't have exact figures because the banks don't publish their short positions in real time, but based on the inventory drawdowns we saw in Q1 of 2025, we're talking about potential exposure in the range of 50 million ounces or more. If they need 50 million ounces to satisfy delivery obligations and the United States is the only source of available physical metal, the premium required to move that metal has to exceed the 25% tariff. Here's the calculation that should terrify anyone short silver right now. Current price $89.94. Add 25%. That's $112.40. That is the mathematical break-even point for global silver flow under the 25% tariff scenario. $11,242 is not a speculative price target. It's not a hopeful projection from a gold bug who thinks the dollar is going to collapse. It's the minimum price required for arbitrage to function under the new tariff structure. Now look at the COMEX inventory charts. I was looking at them a few hours ago, and here's what you need to understand. The registered silver, the metal that's available for delivery, isn't moving. It's sitting there, not because there's no demand, but because the banks can't afford to let it leave. Every ounce that exits a US vault is an ounce that becomes 25% more expensive to replace. The smart money has already figured this out. They're not selling, they're not shipping, they're sitting on their metal and waiting for London to blink. Now, I know exactly what the skeptics are going to say. I've been in this market long enough to predict the counter-arguments before they even show up in the comment section. Skeptic argument? Number 1, this is just a negotiating tactic for Greenland. Silver is a strategic mineral. It'll be exempted before February 1st. Here's my rebuttal. Look at the Section 232 review that was completed just days ago. Read the actual language. It purposefully left the door open for broad-based tariffs on all goods from the listed nations. If the administration wanted to exempt strategic minerals, They would have done it in the initial announcement. The fact that they use the phrase all goods is not an accident. It's a pressure tactic designed to maximize economic pain and force concessions. And here's the thing about negotiating tactics. They only work if the other side believes you'll actually follow through. If you announce a 10% tariff with an escalation to 25% and then you immediately grant exemptions, you've shown your hand. You've revealed that it was a bluff. This administration doesn't bluff on tariffs. We've seen this playbook before. Skeptic argument number 2. The UK isn't even in the European Union anymore. The tariff won't apply to them. Wrong. The announcement explicitly named the United Kingdom alongside the EU nations. Go back and read the press release. It's right there in black and white. 8 EU nations plus the UK. Brexit doesn't protect London from this. If anything, it makes them more vulnerable because they don't have the collective bargaining power of the EU to negotiate exemptions. Skeptic argument number 3. The comics will just change the rules. They'll allow cash settlement or adjust delivery terms to avoid a squeeze. This one actually has some merit. The exchanges have changed rules before when things got tight. But here's what the skeptics miss. Changing the rules doesn't create physical metal. If the LBMA has contracts that demand physical delivery and they can't source the metal because of the tariff trap, no amount of rule changes in New York solves their problem in London. You can't settle a physical delivery obligation with a PDF file. Let me give you my personal dashboard for the next 14 days because this is about to move fast. First, I'm watching for margin hikes on the comics. I expect them by Tuesday or Wednesday. When volatility spikes or when the exchange perceives a squeeze forming, they raise margin requirements to shake out the small speculators. It's standard procedure. If you're trading silver futures on leverage, a 20 or 30% margin hike can force you to either post more cash or liquidate your position. This is how they engineer sell-offs in paper markets while the physical market is tightening. Second, I'm watching the media for what I call the blackout when things get truly dangerous for the banks. You'll see either complete silence on the topic or you'll see technical difficulties in reporting. Watch for redefinitions of what constitutes available silver in London. They'll start separating allocated from unallocated or they'll start talking about liquidity instead of inventory. It's a linguistic shell game designed to obscure the fact that they're running out of metal. Third, and this is the big one, I'm watching the EFP spread. EFP stands for exchange for physical. It's the mechanism that allows traders to swap a futures contract for actual metal. The spread between the futures price and the physical price is normally very tight, maybe a few cents. If that spread blows out to $1, $2, $5 per ounce, it means the paper market has completely decoupled from the physical market. That's the signal that the system is breaking. Fourth, I'm watching every single headline out of Greenland. Any indication of a breakdown in talks, any statement from Danish officials that negotiations are stalling is a bullish signal for silver, because every day that passes without a deal is another day closer to February 1st when the 10% tariff kicks in. And every day after June 1st without a deal is another day under the 25% regime. The banks have 14 days to solve a problem that's been building for 100 years. They've papered over physical shortages with derivatives, with leasing agreements, with accounting tricks that let them count the same ounce of silver in 3 different places. But you can't tariff your way out of physics. Time is not on their side. My personal battle plan for the next 2 weeks. I want to be very clear about something before I share this. I am not your financial advisor. I'm not telling you what to do with your money. I'm a guy who's been stacking physical silver for over a decade, and I'm watching a train wreck happen in slow motion. This is my personal playbook. You do whatever makes sense for your situation. Trigger number 1, the $92 level. If we open Sunday night when futures markets come back online and silver gaps over $92, I'm viewing that as the market confirming the tariff trap. That would represent a breakout above the recent consolidation range. And more importantly, it would show that institutional money is starting to price in the geographic arbitrage trap. If that happens, I'm holding my core physical positions with zero intention of selling. I don't care if it hits 100. I don't care if it hits 120. The metal stays in the safe. Trigger number 2, registered inventory movements. I'm watching the COMEX warehouse reports like a hawk. These come out daily and they show you exactly how much silver is in the registered category versus the eligible category. Registered means it's available for delivery against futures contracts. Eligible means it's just sitting in the warehouse but not earmarked for delivery. If I see large amounts of silver moving from registered to eligible, it means the big players are tucking their metal away. They're taking it off the table. They're making it unavailable for the scramble that's coming. That's a bullish signal. Trigger number 3, the dip on it's just a bluff headlines. If silver dips to $85 this week because the mainstream media runs stories about how this is just a negotiating tactic and cooler heads will prevail, I am personally looking to add to my physical stack. I view that as a gift. It's the market giving me one last chance to buy at a discount before the reality sets in. I'm not talking about leverage. I'm not talking about futures contracts or options. I'm talking about physical metal that I can hold in my hand. Trigger number 4, margin hikes above 20%. If the COMEX hikes margins by more than 20% in a single day, I'm sitting on my hands. I'm not playing the paper game at that point. Margin hikes are a signal that the exchange is trying to suppress price by forcing speculators out. And when they're that aggressive about it, it usually means the physical situation is worse than they're letting on. At that point, I let the physical metal do the work. I don't try to trade around it. Trigger number 5, the London-New York spread. This is the nuclear option indicator. If the spread between London spot prices and New York spot prices hits 5% or more, I'm preparing for a force majeure event. Force majeure is the legal term for we can't deliver because of circumstances beyond our control. It's the escape hatch that exchanges use when they can't meet their obligations. If that spread hits 5%, it means arbitrage has completely broken down. It means the one-way valve is fully closed. It means we're in uncharted territory. And at that point, my personal plan is simple. Hold physical, avoid paper, and wait for the dust to settle. What the banks are really afraid of. Let me pull back the curtain on something that doesn't get talked about enough in the silver community. The bullion banks are not afraid of high silver prices. They've seen silver at $49 in 2011. They've navigated higher gold prices. They can hedge. They can adjust their books. What they're afraid of is a market where they can't move metal to where they need it. The entire fractional reserve system in precious metals depends on geographic flexibility. When London gets tight, metal flows from New York. When New York gets tight, metal flows from Zurich or Singapore or Hong Kong. It's a global shell game, and it only works as long as the shells can move freely. The moment you lock down one of the major shells, the whole illusion falls apart, and that's exactly what this tariff has done. It's locked down the New York shell. The LBMA can't borrow from COMEX anymore, not at prices that make economic sense, not without taking catastrophic losses on the round trip. So, what do? They've got 3 options, and all of them are bad. Option 1, they let physical silver in London spike to $100 or more to incentivize existing holders to sell. Option 2, they change the rules and allow cash settlement, which destroys confidence in the entire LBMA system. Option 3, they declare force majeure and admit they can't meet their delivery obligations. Pick your poison. Every single one of those options is catastrophic for the paper silver market, and every single one of them is bullish for anyone holding physical metal, the front-running scandal. They don't want you to remember. Here's a piece of context that makes this entire situation even more absurd. In the first quarter of 2025, we saw this massive movement of silver from London to New York. I mentioned it earlier, but I want to dive deeper into what actually happened. The banks knew that a Section 232 review was coming. They knew that silver was going to be classified as a strategic mineral. They knew that import restrictions were possible. So what did they do? They moved their metal ahead of time. Dozens of millions of ounces flowed out of LBMA vaults and into COMEX warehouses in New York. It was the single largest quarterly movement of silver between those two markets in recent history. And the beautiful irony is that they thought they were being smart. They thought they were running the restrictions. They thought they were positioning themselves to be on the right side of the trade when the tariffs hit, but they made one critical miscalculation. They assumed the tariffs would restrict imports into the United States, not exports out of the United States. They moved the metal into the US to protect it from import tariffs, and now they've realized that it's the export side that's trapped. It's like a bank robber who breaks into the vault, stuffs his bag with cash, and then realizes the only door out is locked from the outside. They're stuck. And the best part, they did it to themselves. Why this week is different from every other squeeze attempt. I've been through a lot of silver rallies. I was around for the 2011 spike. I've watched countless to-the-moon predictions fizzle out, and I know that a lot of people in the silver community have developed a kind of cynicism about squeeze narratives. We've heard it all before. This is it. This is the big one. The banks are finally going down, and then nothing happens. The price rallies for a week, the banks slam it back down, and we're back where we started. So let me tell you why this time is structurally different. Every previous squeeze attempt has been demand-driven. It's been about investment demand overwhelming supply. It's been about retail buyers or hedge funds piling into the market and trying to corner physical metal. And every single time, the banks have had the same response. They short more paper. They lease metal from central banks. They move physical inventory from other global vaults to wherever the pressure is building. They've always had geographic flexibility as their release valve. This time, that release valve is gone. This isn't about demand. This is about supply chain paralysis. This is about a policy decision that has created a structural barrier to the normal flow of metal. You can't short your way out of a tariff. You can't lease metal from a central bank if that metal can't economically cross the Atlantic. The normal tools that the banks use to suppress price don't work when the fundamental problem is logistics, and that's why this week could be the catalyst that finally breaks the paper market. The Greenland variable. Let's talk about the elephant in the room. This entire tariff structure is theoretically contingent on Greenland negotiations. The administration has made it very clear. Make a deal on Greenland and the tariffs go away. Fail to make a deal and the 10% becomes 25% by June 1st. So the obvious question is, what are the odds of a deal? I've been reading everything I can find on the Danish government's position on Greenland's own political situation on the broader geopolitical context. And here's my personal assessment. The odds of a comprehensive deal by June 1st are below 30%. Here's why. Greenland is not just a piece of real estate. It's a sovereignty issue for Denmark, it's a cultural issue for Greenlanders, and it's a strategic issue for the entire European Union. Because if the US gains control of Greenland, it fundamentally shifts the balance of power in the Arctic. This isn't like buying an office building. You can't just write a big enough check and close the deal. There are political constituencies in Denmark that would rather see their government fall than sell Greenland. There are Greenlanders who view any sale as a betrayal of their autonomy. And critically, there's no urgency on the European side. From their perspective, they can just wait out the tariffs. They can absorb the economic pain. They can hope for a change in US policy after the next election. They're playing a long game, and the administration is playing a short game, which means the odds of a breakdown in talks are significantly higher than the market is currently pricing in. And every day that ticks by without progress is another day closer to the 10% tariff becoming reality. What the charts aren't telling you. I want to address something that drives me crazy about how most people analyze precious metals markets. They look at price charts, they look at technical indicators, they draw trend lines and Fibonacci retracements, and they try to predict the next move based on patterns. And all of that is fine for normal markets. It works reasonably well for stocks or Forex, or even gold most of the time. But silver is not a normal market. Silver has a physical supply constraint that doesn't show up on any chart. You can't see a geographic arbitrage trap in a candlestick pattern.